Hi, this is Ashish Shanker and welcome to the next in the series of Know Your Investment Guru. Today I have a very special guest. He is an engineer from IIT Madras and MBA from IIM Calcutta. He has more than 27 years of experience in capital markets. He's at the helm of affairs at ICICI Prudential AMC. He's the ED and Chief Investment Officer responsible for 3 lakh crores of assets. He's known to be a contrarian investor. So I'm happy to welcome on this show Mr. Sankaran Naren. Naren, welcome to the show. It's really a pleasure to have you talk to us. Naren, 2018 has been an amazing year. I mean, if I look at it point to point, it almost looks like nothing has happened because Nifty is up 4-5%. The yields are, the Indian 10-year bond yields are where they are. Even the US 10-year yields are closer to where they started the year. But we know that's not true because if you look under the hood, there has been a carnage in the broader market. We've seen huge volatility in forex. We've seen crude, being volatile. Your thoughts on 2018?
I think 2018 was, if you look at January, was a period where people were too optimistic. And most people believed that small and mid caps were lower risk and higher return than large caps. 2018 showed the risk of small caps and mid caps and the fact that valuation matters. So if you go back to early January, I think the gap between mid and small cap valuation and large cap was at a record gap. And so I think 2018 showed the adage that valuation matters. And I think it's been an interesting year for people who've been disciplined and a painful year for people who've been indisciplined.
I think you've been continuously messaging, I remember same time last year, that the return was not in favor small, and in fact you returned a small cap fund as well. You returned money to investors.
Clearly we had that view, and our PMS division returned small cap money, and we were of the belief that you should try to bring down mid and small caps in the portfolio and be more positive on large cap and fixed income. I think that call did play out and did give us reasonable happiness to us in 2018.
We saw the fixed income markets were extremely volatile, and we also saw one of the leading financial institutions defaulting. Obviously, it has scared a lot of investors away from fixed income funds because the volatility has been quite unprecedented. I probably think the last time we saw this kind of volatility was maybe in 2013 or maybe 2009, but we didn't see a default this large even at that point in time. Your thoughts on whether are we past this storm, or do you feel there could be any collateral damage still going forward?
See, I think what I find interesting is most people believe that there will be an accident happening in fixed income markets and there will be no accident to stocks and equity market. So if you look at 2018, if you look at most of the ICICI Prudential debt funds, I think the experience for the year has been much better than what you've seen typically in any equity fund. But despite that, I feel that people are much more fearful in fixed income. So they're willing to believe that the equity of some of the companies which are stressed would trade at valuations which are significantly number of times book. But their debt, there is a potential for those debt stock funds to go bad. So I think clearly people are more fearful of debt than they should be, and less fearful of equity than fixed income. I think that needs to get corrected.
Right. So how would you advise a first-time fixed income investor, who's seen this kind of volatility last year? How would you advise them to approach fixed income investing, let's say going into 2019 or going forward?
See, actually it depends on the person. So frankly, if you look at it, if a person is just unwilling to look at risk, then they'll have to look at products like liquid funds. On the other hand, if they are willing to tolerate credit risk and not willing to tolerate duration risk, we have got products like credit risk fund. I think it's important for most people to trust the mutual funds that they have invested in and invest for 3 years I think, and frankly, if you look at our asset management company, we have built a number of processes in credit risk, and we have built a lot of experienced manpower in credit risk. So it's very critical that people need to focus on such things, and that's why I think I would say, as long as people understand that mutual funds are not fixed deposits, and they can deliver many times better returns than fixed deposit, and at times lower returns than fixed deposits, and it's based on the product that they've invested in. I think they can have a pleasant experience. I think the biggest challenge is that in equity, 2008 taught people a lot of things, and people started to understand what is equity. In fixed income, there is a fair amount of learning still required of the intermediary and the investor at this point of time.
So, any key learnings from 2018 as a fund house in fixed income? Is there any change in your process or something that you may have incorporated after we've gone through this period?
So I think more than change in process, we were always conscious of risk. And I would say that we have always been looking at credit risk with the care that it required. I think prior to September 2018, we were not getting the extra return for taking credit risk. I think what has happened now is that you're getting that extra return for the extra risk that is taken. And I would say now in the marketplace, people understand that if a bank fixed deposit gives you 7% and you're investing in a yield to maturity product of, let's say, 10 or 11%, there is an extra risk. I think that's understood by the people, and because they understand it now much better, I think it's much more comfortable for us.
Right. So, how do you see different asset classes behaving, let's say in 2019? What is your outlook, and how should investors approach, building their portfolio or positioning their portfolio?
So I think 2019 for me is a year of accumulation in the equity markets, and it is if in 2018 stock picking just didn't work, I think in 2019 stock picking has a good scope to work. So that makes clearly 2019 very different from 2018. Having said that, do I believe that 2019 will be volatile and recommended to invest through SIP or STP? I would say clearly 2019 is a very good year to do systematic investing. In all past election years, systematic investing has worked. So clearly, I think as an election year, there is clear reason to be investing systematically. Globally, actually, I didn't expect so much volatility. And the kind of volatility that we are seeing recently gives scope for us to actually consider investing in global funds as well, which are available in India. Whereas for most parts of the time, I used to think they were overvalued. But now with the kind of correction which have been seen in big markets like US, I think clearly there is scope to consider even products like the US equity funds at this point of time after the meaningful correction that we have seen.
Do you see any risks in US equities? Because what we've been hearing over the last couple of days is there seems to be a slowdown, and the bond market seems to be indicating the same. Do you see any risk of, let's say, economy again slipping back into a recession, or you think this is a good time to buy the dip?
Yeah, I think there are always risks in equities. I think for anyone who believes equity is a riskless asset class, I think 2018 has taught them the risk of equities. But am I worried about the US equity market in a significant way? I don't think so. I think the correction has ensured that the risk return trade off in US equities is also reasonable at this point of time. Having said that, I think it's important to practice asset allocation. We are not in a time yet where we can say valuations are dirt cheap and one should just focus on equities. I think practicing asset allocation is very important at this point of time.
Right. I mean, I've known you to be a contrarian, and you think different, and we've seen that playing out very well in some of your funds as well. What are the themes or sectors that you're positive on from a 2019-2021 point of view?
See, clearly, if you look at corporate banks, they've done badly for the last 7, 8 years. So they become one interesting theme. If you look at power, for the last 10 years, the sector has delivered no returns. So clearly, when I look at how power demand will go up over the next 5 years, that's an interesting sector. I think clearly, if you look at select telecom stocks, I think they've also not delivered returns over a long period of time. So they also look interesting. So I think you have interesting pockets of where one can consider. Clearly, in the last 3 months, the healthcare sector again corrected a lot, again making it much more attractive than what it was. So I would say there's a wide variety of sectors. When I look at the markets, out of 100 large caps, I would say 10 to 20 stocks look overvalued, and the remaining 80 look reasonably valued at this point of time.
Yeah, I mean, I think last year we saw a very polarized market, which was led by seven or eight stocks. Uh, do you feel comfortable with the valuations in the mid and small cap space now after the correction?
See, I do feel comfortable, but what like one of my colleagues says, normally mid caps have traded at a big discount to large caps. Am I comfortable now compared to 1 year back? Certainly. But are they trading at a big discount to large caps? The answer is no. So while I'm certainly more comfortable than a year back, we've been recommending only systematic investing in mid caps and small caps at this point of time. But we have changed, and earlier there were many interviews where we had talked negatively on small caps and mid caps. Now clearly we are telling that small caps and mid caps are the way to go for systematic investing.
Naren, you've spent more than 2.5 decades in Indian capital markets, and you've seen this country evolving. I mean, from a, let's say, sub $1 trillion economy to today we are close to a $2.5 trillion economy. Over the next, let's say, 4 5 years, let's say 2025, how do you see this country shaping up, and are there any structural or broader opportunities that you foresee?
See, I think basically I would say that the outlook for growth on a 10 to 20-year basis is best for India vis-a-vis most countries in the world. Having said that, I think there is a challenge that people always throw the last 20-year numbers on equity returns and expect that kind of return over the next 10, 20 years. I think we have a much bigger economy and we have a much more competitive ecosystem. That means that you have to prepare yourself for lower returns. But I would say still there is very good scope for long-term investing. And remember, financial markets will remain volatile. If a market like US can fall 15% in no time, I think one has to remember that financial markets are likely to remain volatile, and therefore there is huge scope for long-term investment. But at that worst point in the cycle, in the next 5 years, people shouldn't say, what is this equity market? That should be the time when people should add more to equity rather than worry about equity market at that point of time.
So that brings me to another interesting question. See, we as advisors, one of the challenges we face is we get a lot of money in equities or flows when people are feeling good about equities. And people are normally feeling good about equities when the past returns have been good and stocks have done well. Similarly, like today, flows tend to dry up because people are feeling bad about their portfolios. A lot of portfolios are down, and we don't get fresh flows. And typically, whenever markets are down, it is also surrounded by a lot of negative news flow. So what are your views on timing the market, and how does one come out of this problem of trying to invest and time the market?
See, that's been one of my happiest events of 2018. After watching the 2018 meltdown, I said we should have funds, which have the ability to sell on the way up and buy on the way down. And we created this category called Balanced Advantage category. And in that category, we managed to create assets under management of 28,000 crores. So if you look at 2018, in August 31st, the fund was invested to a tune of 32%. In October 31st, it was invested to a tune of 52% in equity. So we basically invested 20% of a 28,000 crore fund in equity. That means without going to the ultimate customer, we managed to invest 5,600 crores when the markets fell in September, October. It's interesting that we managed to do the same thing in February, March also when the markets fell. So I think clearly a category like balanced advantage has a huge role to play in investors being disciplined. Actually, we had raised a lot of closed-end equity funds in the form of Value 20, Bharat Consumption, etc. And in all these funds also, we had a fair amount of hedge where some of those hedges have come down. I think the secret to, I would say, long-term investing and given the way investors behave is to actually sell products which themselves are asset allocation products, because then you don't need to go to that ultimate investor to try to recover money when the market falls. You have the money, so you sell debt and buy equity.
Fair point, fair point. Naren, at Motilal Oswal, we follow this 4C process of selecting managers. I mean, basically, we look at the philosophy of the fund manager, the clarity of philosophy, the consistency of their approach and performance, and the class or experience as well as the capabilities. Could you give us a little peek into how processes are organized within ICICI Pru AMC? I mean, how do you manage risk? And what is the philosophical framework within which money is managed?
So actually we spent a lot of time on it, and this is my 15th year in ICICI AMC, and the processes had to be evolved, because when I joined the firm, we used to have 2,000 crores in equity assets, whereas we have assets today in equity of 1,40,000 crores. So you have had a 70 time increase in 15 years. So we have had to create a clear research process. So we have analysts looking at different sectors, and actually they've been the heart, the base of the research process. Then we have fund managers, and we have many fund managers looking at different strategies, and they also have grown within the system. So in my asset management company, all the fund managers have been people who have only done fund management within ICICI. And over the last, many of them have been with us for about 7 to 10 years. And in that process, they have been sectoral analysts, they have been multi-sectoral analysts, then they've started to run smaller funds. Now they co-manage many of the larger funds. So it's been a continuous evolution, and similarly on the risk management side, we have had to evolve. So we have strategies like our blue chip equity fund, which are benchmark centric strategies. We have non-benchmark centric strategies. So we have had to create a product bouquet, and each product has its own risk level based on the kind of deviations it can do. And we have also created strategies where there's a lot of cash or hedging. So I think it's been a continuous effort. On a continuing basis, we have actually worked on improving our processes. And I would say it's been a very, very interesting experience. For us to see 2018 was very important, because 2017 was a very heady year. To turn cautious on small and mid cap, we were cautious on small and mid caps, then it still went up for almost a year. We held on to that call, and in 2018 we got all the benefits of that call. Today, for example, we are underweight some mega caps which have outperformed, and that has resulted in some amount of underperformance against the benchmark, not with peers per se. I think again we see overvaluation in some of these stocks, so we have to hold to our research process and not buckle and buy them at this point of time. So it's been a continuous evolution, and I think it will remain evolving, because as the company becomes bigger and we handle more and more money across wider number of products, we have to keep improving our processes to actually achieve the objective of the customer.
You've had a very interesting journey of investing, and I've heard you talk about the Chennai club as well at the beginning of your career. Could you tell us some insights that you may have picked up along the way and which ultimately translated into your investment process or philosophy?
So I think a lot. I would say that, when you're managing your own money or when you are a stockbroker, you have certain a different way of managing money. When you're managing other people's money, and this is the 15th year, and for me actually 2007, 8, 9 was a very interesting period, because in 2007 I was cautious, and actually many of my funds underperformed the benchmark that year by a big margin. and we got back completely the underperformance in 2009, where the market actually did extremely well, and we had a set of stocks which actually even did better than the market. So I would say that, or in the period prior to internet, you didn't have access to information, you didn't have access to the global gurus. So you've had much more advantages of being able to learn from the experience of the Western fund managers, the Western investment theories applicable to fund management, and all those things have helped us a lot over the last 10 to 12 years. And I would say it's been a continuing process. So how you manage a 2000 crore fund and how you manage a 26,000 crore equity and debt fund or a 28,000 crore balanced advantage fund is very different. And we have to learn how to manage large schemes. And so a lot of learning keeps happening, and you make use of the internet, global experiences, our own learnings, our own dealing and fund management and research strategies on a continuing basis. It's a continuous evolution, and we'll have to keep learning. Having said that, can we make some mistakes? Yes. For example, we were a year ahead in determining that small and mid caps have peaked, but for 1 year it kept going up after that. So I would say these are the learnings that you'll have to be early. So many people told me you can sell on the way down. Frankly, no one got an opportunity to sell on the way down. When the markets in small and mid caps fell in February, March, most people watched it. They couldn't sell on the way down. The lessons that we learned was you have to sell on the way up and buy on the way down. That's the lessons again we've learned. So multiple lessons we keep learning in this effort to manage other people's money well.
A lot of people know what to do, but what happens is, when you start executing, that's where the challenge arises, because you often want to go with the crowd. So what kind of mental makeup does a contrarian investor need to have? Because sometimes it can be frustrating, when stocks are still going up, and obviously, you see some of your funds underperforming. So what is it that, how do you keep that discipline? Or
So I think that's the advantage of being in the same place over long cycles. So I have seen 2007, I have seen 2009, I have seen 2011. Each year has been different, and over a period of time, for example, in some of our closed-end funds, I run a fund called Value 19, where we collected 1900 crores in a closed-end category. And in that fund, it was very important for us, it was corrected at the peak of the market. So for us to maintain a big hedge in that product turned out to be a big benefit in September, October 2018. But if you had looked at the performance as on August 31st, it was not good. And, people would have worried was what was happening. But in September, October, we could actually get huge benefits because of the hedges we had created. So I would say it's a continuous learning is part of it. And I would say that if you're going to be affected by the market each day, then you can't manage money for the long term sensibly. You have to know when to be rational, when you think that the market is slightly irrational, and when you have to stay rational. So, I had 3 quotes which I actually used at that point of time. One was a quote of Chuck Prince, who said that when you will have to keep dancing while the music is on. And frankly, that taught us that you have to be ahead in small and mid caps. John Maynard Keynes said that markets can be rational longer than you can be solvent. And that also helped actually in 2017 to prepare myself. And as Warren Buffett said, it's only when the tide turns, you know who's swimming naked. And that was so beautifully seen in September, October, November, when suddenly out of the blue, many of the high-flying sectors went into a decline because of what Warren Buffett said. Warren Buffett also said one thing: you have to also keep looking at how much risk others are taking, and based on that you have to take the decision. And that's something which played out in the second half of the year very well. So I would say we are in a very lucky period because we have access to the Western world's experiences. We can watch what mistakes they have done. But the challenge is that investors want us to deliver day in, day out. Can't happen. There'll be times when the market is irrational and you have to be rational. That time you can't create alpha. but you have to, that point of time, hold your emotions. And I'm a big believer in behavioral finance, because I have seen over a period of time it's behavioral finance which helps you to deliver long-term alpha.
Right. Naren, one of the other challenges that I've seen of value investing, or trying to be a contrarian, is sometimes you end up buying value traps. Obviously, it is in hindsight that you get to know they are value traps. Is there any process that you have to avoid value traps, or at what point do you say that, okay, this hypothesis is not working out, and at what point do you sell?
Actually, my personal experience has been that I have people, young, educated people who join the firm, who don't carry my biases. So they act as a powerful counterpoint when I start buying value. And very often they have actually helped me in restraining my interest in buying value, because they don't come from a value school. So they all come from the fact that they have good capabilities and the ability to work hard. I would say it's many of the younger people in the team have helped me to restrict my positions. And clearly, one of the lessons you have to learn from investing is value is not buying junk. Value is buying cheap against intrinsic value. And the day you think value is equal to buying junk, then you're headed for the problem. And that is a lesson we have kept learning. I think in 2008, anyone who bought junk, many of those stocks never came back. Whereas if you bought actual value, they all came back in 2009. So you had those lessons, and I think it's a task to convince people that value doesn't mean buying junk or buying cheap. Value is buying cheap against an intrinsic value. And that's a lesson that we have to keep communicating to people. And I would say, I believe that fund management or even investing is about three things: buying, sizing, and selling. And people don't realize that sizing is an important part of the entire argument. And I think we have a lot of internal debates on sizing. And I've seen across that sizing plays a big role in mistakes. And I would say it's very important for you to have good amount of debates on sizing to prevent big mistakes from happening.
Right. One area, Naren, which is not often talked about, or I don't see too much of content around it, is the third point that you made, selling. Because there are a lot of books on how to buy, what to buy, when to buy, but very little on how to sell. Your thoughts on it?
See, from an investor angle, it's very easy actually. It is the ability to practice asset allocation all the time. And the second thing about selling is, if you know that there is a bubble, whether it is Bitcoin, whether it is small cap, whether it is real estate, how to sell in a bubble is the second learning, I would say. And what my guru Howard Marks keeps talking about is cycles. You have to remember that there are cycles. So I would say that as long as you're able to believe in asset allocation, you recognize that there'll be periodic bubbles and busts which you have to navigate, and you recognize cycles, I think you will sell. The problem is most people want to avoid thinking about these three at the wrong time. So in 2012-13, they think it's enough if you're only in real estate. In 2017 end, they think it's enough if you're only in small cap equity. So I think you have to get out of this entire process by being disciplined on asset allocation. And that's where I think wealth managers like you have actually, through all your monthly mails, kept on reiterating asset allocation.
Right.
I think if you reiterate asset allocation and practice asset allocation, that is almost winning the battle.
Right. I mean, quoting Howard Marks, I think he says that you don't need to predict the cycle, but you definitely need to know where you're in the cycle.
Exactly.
I think that framework definitely helps in allocating. Your advice to somebody who's starting out his investment journey today, whether he's an investor, or an advisor.
So I always tell people, practice asset allocation. Then in the asset class that has done very well, don't get drunk. So if real estate is the asset class which has done very well, don't get drunk in real estate. If equities is the asset class which has done very well, don't get drunk in equities. These are the only two things that I would say which is very important. And being disciplined in asset allocation is enough for you to make money in your entire investment career. The task is to be disciplined in asset allocation. Actually, it's too easy, but somehow people find it difficult.
Absolutely. I mean, it's about diet. I think everybody knows what to eat and what not to eat, but to practice it is the most difficult.
Exactly.
You know, at Motilal Oswal Wealth Management, we believe in creating winning portfolios powered by knowledge. Any essential reads for investors, or advisors to enhance, their knowledge on this subject and investing?
See, I think there is a fair amount of reading material today available on the web. And I would say that having said that, to make money, all you need to do is practice asset allocation and not being drunk. But from a reading point of view, I would always inculcate people to read a good economic newspaper. I come from the older school of reading newspapers in print. There are a lot of people who read websites. I would say being disciplined in reading has always helped. And I would say that if you are, I have my own gurus who are Howard Marks, James Montier, Michael Mauboussin, and I would say like that different people can over a period of time decide we'll follow these people, how they are talking and thinking. That's what I have seen. So I don't think being a good investor is difficult, but to be disciplined is not easy.
Absolutely. Naren, it's been really a pleasure and very, very interesting chatting. We can go on and on, but there is a constraint of time in this format. So thank you very much for sharing your insights with us, and hope you continue doing what you do, managing money for our clients and creating wealth for them over a period of time. So thank you very much, Naren.
Thank you.
So that was my conversation with Sankaran Naren. I found the conversation really enriching, and I am better off after this conversation as an investor. I hope you found this conversation insightful too. You can go to our YouTube channel to watch these interviews, follow us on Twitter, or write into us on our email ID. Thank you very much for watching.